Hello and welcome to Property Question Time. This is the programme where you can have your property-related questions answered by our team of experts. I'm Stephen Galpin, and with me today are Andy Woods, Director of ETC Tax, welcome.
Hello.
Paul Mahoney, Founder and CEO of Nova Financial Group and now author.
Stephen.
Okay, and Simon Zutshi, Founder of Property Investors Network.
Hi, Stephen.
And author too, I think.
Indeed.
Right, welcome gents. Andy, I'm going to go to you first, and your question is, if one of my buy-to-let properties effectively loses money over a 12-month period, perhaps due to rental voids, can I offset those losses against the profit on another of my properties that I own?
In short, yes, because the way the tax is dealt with is that all your properties, generally speaking, are going to form one big property business. So essentially, all the income and all the expenses of that property business are going to be brought together. So you have the ability to offset the excess of expenses against other profits, essentially.
Okay. So, simple answer then? Nothing complicated?
Yeah, so the simple answer would be yes. What you have to be careful of is you could have different types of property business, and you might not have been in quite the same position. So,
okay. Well, assuming all the properties are on a par, so I think what you're saying then is that if you have these held in your own personal name, they're almost treated as one then.
Correct,
by revenue.
Yeah.
Whereas, of course, in a limited company, they may be separated.
Yeah, there's one exception there. There's always at least one exception, isn't there? Is where, let's say, you have a property and you let it to one of your mates at mates' rates, or you let them up it free of charge, and then you can only offset that loss against any profits from that property in the future.
Okay. Paul?
I don't know, so a slightly different way of looking at it is it's the income and the expense that contribute to your personal income, isn't it? You know, although it's a property business, if it's in your own name, it's just the income minus the expenses, and the net of that contributes to your personal income, including your employment income. So, you know, that's how it works when you're a self-trader.
So when somebody's looking to finance perhaps a portfolio, do the banks and the lenders take into account the potential voids and potential losses and one against the other?
Stephen, I should have thought of that. Yeah, well, yes, it's a very good question actually, because it's quite relevant. There's been some changes in the market recently. Lenders look at, for portfolio landlords, so people who have more than 4 properties, they will look at the whole portfolio. So for example, if one is making a major loss and that drags down the profitability of the whole portfolio, that could affect the financeability of the other properties. Yeah. So yes, they do. If you have less than 4 properties, they don't. It's still just about the individual property.
Yeah, and so just to tax you on this a little bit, so when a lender has lent into your portfolio, let's assume on an individual basis, so in your own name, is there a requirement to provide them with sort of trading accounts periodically or not?
If you're a portfolio landlord, so if you have 4 or more properties, there's 2 requirements. So you need to provide a business plan and a cash flow analysis. Sometimes if you've got a large portfolio and you've got a lender lending to you on a commercial basis, they might come in and review the portfolio every now and again, but not for most landlords. It's mainly only when you're remortgaging or buying.
Okay, all right. Anything to add, Simon?
I mean, pretty comprehensive answer there. The final thing I would say is that a mistake that many new investors make is they buy a property and they might not actually make any money in the first year because of the setup and things, and they think, oh, I've not made any money, I don't need to declare it. Well, that's a mistake. You need to always declare the income or the loss, and then on that first property, or any properties, if that loss can be carried forward to future years and offset against future tax as well.
Okay, good advice. Okay, gents, thank you. Paul, your question. I'm thinking about investing some cash that I have into property renovation on a small scale only. I'm talking about having enough cash to put down 25% deposit and enough left over to fund the renovations. Can someone advise the best way to finance the rest of the property purchase? Is there a special type of mortgage for these kind of projects where the process from start to finish would likely to be less than 6 months?
Well, the answer simply is yes. Traditionally, it would have been short-term finance, so what's often referred to as bridging finance, where they would have had to, assuming this property isn't habitable, because they're having to do the renovation works. If it's not habitable, which can mean a number of different things, if it doesn't have a kitchen or bathrooms or those sorts of things that obviously you need to be able to live in a property, it would generally be viewed as uninhabitable. And before some more specialist lenders came into the market and started providing some sort of quasi buy-to-let products, where you can buy a property that's uninhabitable, but you have a period of time to get it habitable, and then they'll switch you over onto a standard buy-to-let. So there are some new products in the market that are specific fit for purpose for what they're looking to do.
So would that initial finance be more expensive than the...
Generally, yes, but it will probably be cheaper than your traditional bridging, which is quite expensive.
Okay. Andy, would there be any different tax treatment for bridging finance versus longer term finance?
Not really. Not that I can see. No.
Okay.
I'd say the main reason there wouldn't be is generally bridging. When you use bridging, you're not generating any income.
No.
Whereas obviously, buy-to-let mortgages you are, and therefore it's looked at differently from a tax perspective.
But would you be able to move the bridging finance into the catchment of your clause 24?
I mean, in theory, if you had a bridging loan and you were paying interest on it, and you had a property and you're generating income, you would be the basic principle. You would be able to offset it, but then you would be into the normal restrictions. If you're an individual or an income taxpayer, then you have to deal with clause 24. If you're a company, you don't.
Okay. Simon?
Just final thing to add, as Paul said, traditionally you would use bridging. That's where the new crowdfunding can come into practice, where there are peer-to-peer lenders who will help you fund the purchase and the development costs. You just need to put the deposit in. Okay. And then you refinance 6 months later once it's all up and running. Mm-hmm. That can be really useful. If you're doing maybe a normal house into an HMO, some HMO lenders want you to have 6 months of experience. And well, if you don't have an HMO, how do you get the experience? So going to a peer-to-peer lender who will help you develop that property, you then run it for 6 months as an HMO. That gives you the experience. You then put it into an HMO lender.
Okay, fine. Great stuff. Well, we'll keep you working. Your question now. The probate process following my mother's death is due to complete next month. I'm due to inherit £135,000 and I'm unsure how to manage or invest this money. I'm married with 2 children, work full-time. I don't necessarily want to pay off the remaining £109,000 of my mortgage. Each of my children, aged 9 and 6, will also receive a monetary gift of 10k each, which I wish to save for them for when they're older. Not sure best options. Everything seems like a minefield and is so overwhelming. Any help and advice would be gratefully received.
Well, that's a huge question for such a short amount of time. When everyone's making any investment, I think it's really important to understand what are they trying to achieve from it. Do they want to get capital growth? Do they want to get income, or some combination of the two? As we'd be slightly biased, we believe property is probably one of the best investments to make. There are other things, they can do shares, but there's some volatility there. They can just put money in the bank, which actually the rates you get these days is the money's devaluing. I think that some people might decide to take their money and clear off their home mortgage, because your home mortgage is your biggest outgoing, and at some point in the future you have to pay it off, and so that for that person could be good advice. However, if they have the aspiration of actually building a portfolio, that's a great opportunity to use that money. A home mortgage might cost them 1-2%. They could earn a lot more money on that $135,000 by investing it into investment property. If they're busy, they might want to get a property that's as hands-off as possible. They might go to a company that could source that property for them, manage them. They'll pay fees because of that, but they've got to weigh up their lifestyle and how much they want to get involved in property. It is very possible to have a full-time job and have kids and still be a property investor if you get the right kind of team around you to help you.
Paul?
Yeah, look, I obviously agree with Simon. This person doesn't look like they wanted to have a second job. So if they're going to invest in property, they probably want to do it quite passively. I'd say definitely very, very seriously consider it. Not only because property is a good opportunity, but think about the downside. From what they've said, it doesn't seem like they've got any investments. Now, that's a big problem because the state pension is not great and might run out, might not be there at all. So think about how you're going to provide for yourself in the future. And that money they've just inherited is probably going to really help them do that if they invest it well.
Okay. I do think this question comes up again of taking people out of their comfort zone. I mean, some people are born to handle investments, others are not.
Very true, yeah.
So I think it's quite important
And that's why getting advice and help.
Yeah.
Don't make an isolated decision. If you want to invest in property, find some friends or family who've done it and ask them about their experiences and see if it's going to be right for you.
Well, I think this programme demonstrates that there's a myriad of ports of call for advice, so take it, I think. Okay, that's all we've got time for in this half of the programme. Join us again after the break.
Property is a great investment option, but it's one of the largest purchases that you'll ever make. As individuals, we're all limited by our resources, and regardless of our experience, knowledge or time, we can achieve much more with the help of a qualified team and extra resources being available. Nova Financial specialise in assisting clients to achieve financial freedom through property investment. With over 100 years of experience, we shape your family's future. To invest in property with absolute confidence, call us on 0203 8600 or visit nova.financial.
The tax system has evolved significantly over recent years for property investors and developers. You may think that you and your accountant have a grip on these changes. However, unless you're receiving specialist tax advice from a specialist tax advisory firm, then it's unlikely to be the case. At ETC Tax, our team of highly experienced chartered tax advisors work with private individuals and companies to deliver effective tax planning whilst meeting HMRC compliance requirements. Let us help you to meet your personal or commercial objectives in the most tax-efficient manner. ETC Tax, making the complex simple.
Hello, my name's Simon Zutshi. I'm the author of Property Magic, which you can buy on Amazon for $12.99 or indeed get on Audible if you prefer listening to books. Now, I started investing in property in 1995 and I became financially independent by the age of 32. But I made a huge number of mistakes because I learned the hard way. You don't have to do that. I've explained in this book how you can make a huge amount of money investing in property when you know how to do it. And one of the secrets is working with motivated sellers. People for whom the speed and certainty of the sale is more important than the amount of money they get. And we look to find people who've got a problem and come up with an ethical win-win solution. I explain exactly how you do it in here. It's a bestseller. You can buy it online, as I said. However, you can get a complimentary copy. All you have to do is phone the number below or go to the website. I ask you just to pay for the postage, tell us where you want to send it in the UK, and we'll send it completely free of charge to you. Call us right now and we'll send a book to you straight away. Learn how to invest with knowledge, invest with skill.
Welcome back to Property Question Time. I'm Stephen Galpin and with me are Andy Wood, Paul Mahoney and Simon Zutshi. Welcome back, guys. Andy, your question for this half. If I sell my portfolio of buy-to-let properties, say after 5 years, and presuming I make a capital gain on them, can I get any tax relief against those profits if I reinvest the money in more buy-to-let properties?
Okay.
There's a little bit extra on that. They're saying that their reasoning for asking this question is they want to keep their portfolio really up to date, so clean, fresh properties after every 5 years.
Okay. The basic answer would be no. There wouldn't really be any relief. So when we're talking beyond the annual exemption for capital gains tax purposes, it's about 12,000 at the moment. That's if it's sort of a normal residential investment portfolio. If it was a portfolio which qualified as furnished holiday lettings, then potentially you could get entrepreneurs relief on the sale, or perhaps more attuned to the question, you could potentially get rollover relief on furnished holiday lets, which means as long as you're reinvesting the gain back into other qualifying property, then the gain will be deferred until the sale of the other furnished holiday lets. What they might also consider doing is, I think was it a portfolio of 5 properties.
5 properties, yes.
Yeah, we don't have much more information than that. But if you could, if you could make the argument that that was qualified as a business for tax purposes, you could consider incorporating the portfolio, which would be transferring it to a company. The effect, and you can do it in a tax neutral fashion if it's a business, and there would need to be some further input to determine whether it was. But once the properties are held by the company, they're deemed to have been acquired at today's market value. So if it's incorporated today, the company acquires them at today's market value, and the company could then go through a process of selling some of the properties, and the company wouldn't have any gain.
But would you incur a personal liability then at the uplifted rate of putting them in the company?
Well, that's the importance of having it being a business, because there's a specific relief which applies, which is often referred to as incorporation relief. It means that you can essentially transfer the properties without there being immediate capital gain. You'd have to think about stamp duty, in particular, as an issue, but that would be a way of then taking your time and disposing of the properties.
If you were a director of the company as well as the individual transferring, could you not exempt yourself from stamp duty with that, same as a group sale?
No. So stamp duty would apply, and the basic position would, because you're transferring it to the company that you own, there will be a market value, essentially chargeable consideration there. But in terms of capital gains tax, you could weigh up the SDLTV versus the capital gains tax saving. Yeah.
Okay.
But clearly you'd need to get some further advice.
My question would be, why are they selling?
Well, I think they did make that clear. Is they want to seem to churn the properties every 5 years to make sure they've got really up-to-date property.
They could paint them,
Well,
or just a light renovation.
well, do you know, that's the best answer we've had all day.
There's a lot you can do to a property rather than selling, because selling's very
Who needs
expensive.
an accountant? Eh?
Yeah, it's relevant though, because selling's expensive because of the tax.
Yes.
You pay agent fees and capital gains tax, which is a big chunk of what you've built. So firstly, why are they selling? They've mentioned about having fresh properties every 5 years. They could do a little bit of light refurb, or they could even build on the portfolio. Remortgage the 5 and buy 5 more. And therefore, they're still offering new properties every 5 years, but they're actually building on what they've got as well.
Yes. I mean, it's a very important point you raise, isn't it? It's the in and out costs of buying and selling these days are huge. Agency fees are huge. You've got stamp duty at certain levels with premiums. It's quite expensive. Simon?
I completely agree. I'd hold on to them, because if you don't sell them, you never pay the capital gains.
Right.
And if you die, the capital gains is wiped out, because they want to charge you inheritance tax instead. So there are other things you can do. But I would, the thought of selling 5 properties every 5 years and having to get another 5, the time and hassle, as well as the extra costs, is just crazy. It's got to be more cost effective, as long as they're good in the first place, to just refurb them, freshen them up, which houses need that after 5 years, flats need that after 5 years anyway.
Yes, and I would imagine the refurb cost would be an awful lot less than just the professional fees anyway.
Yeah, exactly. And actually, if they're selling them in an unrefurbed state, they're not going to get the best price anyway. So that's a bit of a short-sighted policy, I think.
I think a lot of people overlook the tax effectiveness of remortgaging.
Yeah.
It's effectively tax-free money that you're taking from your portfolio and doing with it what you like. You obviously can use it to buy more properties, or you can use it for pretty much whatever you want, so long as the lender's okay with it. But it's effectively releasing cash from your portfolio without having to sell anything.
But if you do that, and you do it presumably on the basis of a valuation, your valuation's gone up, are you not letting yourself in for a tax bill there, putting the properties in at a higher level?
Into
the company? Because if you've revalued them within the company, and there's let's say a 20% gain on them, you've taken out a new mortgage at that higher level. Can revenue not come to you and say, well, there you are, you see?
Well, if you were transferring them, you'd want them to be transferred as a higher value as possible for capital gains tax purposes. For stamp duty purposes, you wouldn't necessarily want that outcome. So it's difficult. The objectives and whether it's a sensible direction aside, even advising purely from a tax point of view, there's so many factors and permutations there that it's difficult to do it in a
The same thing again, important to have your sort of way in and way out. I think. Okay, Paul, your question. I need to remortgage my current and main house. I do own another which is mortgage free and rented out privately. What questions are the mortgage lenders likely to ask over the phone or face to face? Is it better going through a broker in cases like this?
It's always better to go through a broker, and not for any self-serving purposes whatsoever, because if you go down and speak to your local bank, they'll probably be a high street bank firstly, and will have the most restrictive lending criteria of all the lenders in the market. But they'll also only have their criteria and their set number of products. So they might say no to you, or they might offer you a product which might not be the best for you. You could go and speak with 10 banks, but that's still only 10 of the many more that's available. Whereas when you speak with a broker, a good independent broker that knows what they're doing, has experience, has done what you're looking to do quite a lot before, they'll know quite quickly what are the best lenders for you. Firstly, most brokers have software where they plug in your details and plug in the property details. So even if they don't know what they're doing, they'll have a better idea than you would as an individual. But if they do, then they'll find you a much better product than you'll find on your own. The other thing to consider is that a lot of products are only available through brokers. About half the market is only available through brokers. So even if you spoke to every single lender about every single product as an individual, you only get half the market. So that's really important to consider. Some other things, so they mentioned they're remortgaging their home to buy another property, is that?
I think that's essentially
and they have a buy-to-let also.
Yes.
One question would be why they're doing it against the home and not against the buy-to-let. So it's more difficult to get a residential mortgage than it is to get a buy-to-let mortgage. It's also tax deductible somewhat to get a buy-to-let mortgage. So, if they're getting a mortgage against their home, that's going to be very much based upon their income, and the income might limit how much they can borrow. Most lenders will go to 4 to 5 times your income. But depending how much they already owe on that property and how much they want to release, that might impact things, also their credit rating. Whereas with the buy-to-let, because it's considered a commercial mortgage, it's much more about the property that they're mortgaging against than it is about their personal situation. Yeah. And also, because of that, so long as the property is giving a decent rent, they're probably more likely to get that mortgage than they are to get the residential one.
Okay. Paul, one question we have sent into us quite a lot is a question about brokers. So when you receive a commission from a lender, are those commissions pretty standard? Because the inferences from the questions is how do I trust the broker is really giving me the right advice as opposed to the most profitable advice?
Yeah, it's a good question. The commissions aren't standard. They vary a bit. But in saying that, the commissions for resi and buy-to-let mortgages aren't necessarily high either. So, in my experience, you don't necessarily want to go to a free broker because it obviously stands to reason. If a broker's not charging you a fee, they need to be getting their money from somewhere. And most good brokers that I know charge fair fees, but it means that because they're charging a fee, they can be more objective in their advice. Because it doesn't matter if they're dealing with one of the lenders that's giving them a very small commission, which is disclosed anyway, because they've already got a fee from you. So I think some people just look for free brokers, but quite often they're either people chasing commissions or very big companies that you might be dealing with a young kid that doesn't really know what they're doing, versus good brokers who in general do charge a fee, but not ridiculous fees either.
Simon, your question. I have a tenant who's signed a 6-month tenancy renewal until the autumn. They've lived in the house for nearly 10 years. I don't want the tenant to continue in the tenancy beyond their current agreement. Will I need to issue a Section 21 telling them that I want them to quit? And if so, how much notice do I need to give them?
Okay, so a normal standard 6-month AST contract, assured short-term tenancy contract, the tenant needs to give just 1 month's notice to leave after the 6 months. So if they want to leave at the beginning of month 5, they'd give a notice to leave at the end of the 6 months. But the landlord needs to give 2 months notice. So if they wanted, and it has to be a full 2 months, you've got to be really, when you do a Section 21, you've got to be very careful on dates you use on there. So they would need to let the tenant know 2 months before the end of the 6 months to move them on.
So they can issue the Section 21 at 4 months then?
Correct. Okay. Yeah, but it's with 2 months notice. Okay. And then at the end of a 6 months contract, it goes on to a rolling periodic renewal, but it's still the same thing applies. You still have to give 2 months notice to the tenant. They only have to give you 1 month's notice. So it is very much in the favour of the tenants. You mentioned that they've been in there for 10 years. Now, it's good they're on an AST contract. One thing to be careful of, a mistake people make when they buy properties with sitting tenants, they have sometimes what's called a protective tenancy, and they've been in there for a very long time, and you cannot increase the rent, you cannot get rid of them, and often those properties are very, very cheap because they're very difficult to mortgage, so just be aware of those. But that's not the case here, which is good because they're on an AST contract. So yeah, you just issue them a notice. We don't know much about the situation here, but I'd want to know if they've been in for 10 years, they're probably a good tenant, hopefully looked after it. Unless they're selling the property, I'd wonder why they want to get rid of the tenant. Because actually, I've got tenants who've been a very long time. I'm really happy to have them there because it's a consistent tenant, they're paying. If someone's been in 10 years, if they get that tenant out and they want to rent to someone else, they're more definitely going to have to refurb that property because after 10 years, it'll be quite, bit of wear and tear on it. The current tenant might be quite happy with the way it is, but a new tenant probably would want a new enhanced property. That's going to take some time to do. There's going to be some void periods. So, sometimes people think, well, this tenant's on a very low rent and I haven't really put it up. I would say, well, unless they're a bad tenant, which is unlikely if they've been there 10 years, I'd chat to them and say, look, it's been the same for a while. Can we put the rent up? And that might be more cost effective than kicking them out and redoing it and putting new tenants in.
Look, two things about what you said. I've seen before in the past, some agents will attach a Section 21 to the original lease agreement and have the tenant sign it on day one.
Yeah.
But I've also
I don't think they can do that anymore.
No, I've heard sort of district judges say that's really very bad practice.
Yeah. And, a lot of agents used to do that, but I don't think they're supposed to do that anymore.
Okay. And the changes of Section 21 that the government are proposing are to?
Well, they're now talking about having much longer tenancies and not being able to get rid of tenants. But actually, I think that's a very ill-advised strategy for the simple reason that, sometimes a landlord, they need to sell the property. Maybe they've come to the end of their mortgage term, they can't remortgage it. Lenders like to have a 6-month AST because if the landlord doesn't pay the rent, they can get rid of the tenant. So where's that going to leave lenders? I think it's a very, very dangerous policy the government are talking about.
Okay.
Yeah, I agree. Also, I've noticed since that's been discussed, a lot of people think it's already a thing, and it's not. It's literally just been mentioned.
Yeah.
And it was something that will probably take a long time to come to fruition.
Yeah.
I've had people asking, well, how does that mean I can't get rid of my tenant ever? And it's just literally something that's been mentioned. So don't get too worried about that until it's actually starting to happen.
Well, that's a good note to finish on. Thank you very much, Paul. Thank you to all my guests, Andy Woods, Paul Mahoney and Simon Zutshi. Thank you all very much for your contributions. That's all we have time for today. Join us next time on Property Question Time.
If you have any questions you'd like to send to the experts at Property Question Time, you can submit them via our website, on social media, or email us on info@propertytelevision.co.uk.
The tax system has evolved significantly over recent years for property investors and developers. You may think that you and your accountant have a grip on these changes. However, unless you're receiving specialist tax advice from a specialist tax advisory firm, then it's unlikely to be the case. At ETC Tax, our team of highly experienced chartered tax advisors work with private individuals and companies to deliver effective tax planning whilst meeting HMRC compliance requirements. Let us help you to meet your personal or commercial objectives in the most tax-efficient manner. ETC Tax, making the complex simple.